Very good morning, delegates. Welcome to today's breakfast meeting. We have two sessions for this breakfast meeting, Big Data and IFRS 9. The sessions will be handled by Dilip and Rajakumar Chandrasekharan. May I now request Sriram to formally introduce the speakers.
Good morning to one and all. It gives me great pleasure to introduce both of the speakers. Both of them are well technical and technological persons. So to start with, Dilip Kumar. He did his articleship in Mumbai, Sudhit K. Pratik, and in Billboard also, KC Tarak. And he worked in ICICI as a manager in Treasury and Finance, and in HSBC as assistant VP and promoted to VP in product control. And in Barclays, he is working as a director now, as in director in product control. So he has more than 14 years of experience in product control itself. So we have a well experienced person to help us guide in this IFRS 9, which is one of the most debated and convoluted topics in my opinion. Then we have Mr. Rajakumar Chandrasekharan, who will be taking us through big data. And his qualifications are BTech and MTech in Anna University, and he got a gold medalist in MTech also. And he worked in Satchcorp Limited as delivery head, and Atlas System Private Limited as a VP. Then in Den and Bradstreet Technology as a VP and a director, and now he is a director in information, industrialization and transformation in Barclays. So he has more than 20 years experience in global delivery management, project and performance management, service delivery management, infrastructure management. So these people will help us guide through these two topics, which I think is one of the most important topics of the day. Welcome, sir. Please occupy the desk.
Please put your hands together to welcome both the speakers. Before we listen to the speaker, let us rise for ICA motto. Thank you, delegates. May I now request Dilip to handle the session.
Okay, thanks Sriram, and thank you, sir. Good morning to every one of you. Oh, looks like a heavy breakfast. Or not had any breakfast. Okay, so I'm not technical expert in terms of the the accounting standard text, or I'm not going to talk through what are the sections, what are the clauses, etc. So I'm going to talk about more of the practical applicability, how we look at the IFRS 9 when it comes to investment banking or all the related financial assets. So excuse me if I'm not very well versed with the accounting standard language. So that is something probably which I'm not very familiar with. But yeah, I will be able to talk through a couple of examples and how do we apply these standards in day-to-day practical life. Okay. Before I start, just one small disclaimer. So if I'm talking through something, this is not representing anything from the Barclays perspective, it's my personal view. So please don't correlate this with anything with the Barclays. I'm going to cover 3 or 4 large aspects, and there is other pieces which I am not touching upon, given that probably will not have that much sufficient time. So to start with the introduction, then we'll move on to the classification and measurement. As brief touch upon impairment side, how does it work, and what are the various stages of impairment, etc. And then especially talking about the modification. There are other component in IFRS 9 which is like quite technical a little bit, and when it comes to practical activity also there is quite complex. Be it's like financial guarantee is one of the element, and when it comes the reimbursement asset which is also associated with the credit risk, hedges, etc. So if time permits, probably I will try to touch briefly on those ones as well. Before I start, just trying to understand, I hope everybody already understand what is IFRS 9 is all about, right? The basic, or do I need to go through it?
Complete from scratch.
Complete from scratch. Okay, no worries. So, why IFRS 9 is required? Whereas we already had an IAS 39 in place, right? So there are a couple of, I won't say couple of actually. So the credit crisis when it came in, the existing IAS 39 was not sufficiently providing an evidence that we are literally accounting for the risk associated with those financial assets well in time. Then probably that requirement came in, do we need to look through and do we need to draft the whole accounting is trying to come up with when how can we account those events in a timely manner, which is well before, rather than waiting for the event to happen. Can we account for those kind of stuff well before, within the time? IFRS 9, it changed basically, probably I would say the scope of financial asset has changed significantly post IFRS 9. So earlier, loans and advances and probably available for sale instruments was well within the scope of impairment for sale. Post IFRS 9, along with that, there are various other balances which came into scope, be it settlement, receivables, or margin balances, collateral, etc. Those kind of stuff has come in. So if you look from the financial asset perspective, probably I would say close to 25-30% of the balance sheet was in the scope of IFRS 39, whereas post IFRS 9 it moved towards more than 70-75%. This is, I'm talking about from an investment bank perspective, not to be generalized with the other industries. When it comes to classification and measurement, the focus has changed, or a very significant emphasis has been put forward on how you classify your asset when it comes to accounting standard. So there are 2 basic criteria which has been described. One is talk about the business model, and the second one talk about the SPPI test. So SPPI test is nothing but basically you are talking about the cash flow which is generated out of the assets. It's solely for payment of principal and interest, right? There are some smaller changes with respect to the own credit. When it comes to own credit, which is designated through fair value options, which primarily will be kind of an structured notes liability which has been issued by entities. So there is some changes wherein instead of an OCI, rather than instead of OCI, instead of the P&L, it will go to the other comprehensive income without having an option to recycle into the P&L. So that's one of the change which will happen post IFRS 9. In terms of impairment, it's a very, very material change. We have completely changed from the expected credit losses. Instead, we changed to expected credit loss instead of the incurred loss model. So rather than waiting for the event to come forward, we will predict based on the expected, there are a couple of parameters. Based on that, we will predict that how much loss is expected out of the credit event or credit quality of the assets, and we will recognize those well before the time. There is a hedge accounting aspect also, which is still open. So open in the sense you can still continue to apply the IAS 39, waiting for one project to get finished. Until that, you can continue to apply IAS 39 or move on to the IFRS 9. The change in hedge accounting will happen basically, so there is an stringent thing called about IAS 39 is 80 to 125 criteria, probably every one of us would be aware of, right? So when it comes to hedge accounting, what's going to change is it's gonna allow you to basically replace the hedge ratio with being more consistent with your risk management approach. So when I say risk management approach, so let's say you are not hedging the entire 100% of your risk, and if you are planning to hedge a certain portion of the risk, then you can continue to apply the hedge accounting instead. It's not that stringent as IAS 39. It's published in July 14 with the effective date beginning on after Jan 2018. There's an early adoption which was allowed for on-credit related change, and very important thing, the transition. So on the transition side, it's not asking us to do the restatement of the previous financial years, right? So what it is asking us to do is all the transition related adjustments you just put through the retained earnings for the transition period and then move on. So there is a lot less work compared to the all other accounting standard where it requires, the old historical previous one, where it's required to restate the previous year's numbers. Slightly more on the financial asset. How does the classification work? So in terms of the P&L recognition, there are three, which is amortized cost. Then you have fair value through OCI and fair value through P&L. The very important aspect of how do you classify the asset is dependent on, as I mentioned, two factors. One is what is your business strategy? What is your business model? Is your business model is to collect the contractual cash flow of the asset by keeping the asset until the maturity? Or your business model is to optimize the return on the asset? So if you say it's optimize the return on the assets, it could be you want to keep the asset until the maturity, or in between, if there is an opportunity, you might want to sell and increase your yield on the asset. Any other things which is not classified in the two, that's called an other business model. So now let's say you have a business model which is to collect the contractual cash flow of the asset. The another condition which comes into play is whether the underlying asset is meeting the SPPI criteria. So as I mentioned, the SPPI is nothing but whether the cash flow which is being generated out of the asset is only principal and the interest on the asset. If there is any other element which is associated with the assets, that will fail the SPPI criteria. In that sense, you will move directly into a fair value through P&L accounting classification. So what happens here? So let's say you have a debt instrument, a plain vanilla debt instrument, right, which is just giving you amortization of the principal in between and an interest. The interest could be fixed or a floating. Along with the floating, it could have certain margin associated with it, right? So if these kind of assets are, in the portfolio, these kind of financial assets the organization is holding, so they can look for whether the business model is hold to collect cash flows, they wanted to keep the asset until the maturity, and those kind of assets will meet the SPPA criteria. You can go through, amortized cost accounting. Now, when it comes, the second business model, when we talk about you want to optimize the return on the asset, though it's meeting the SPPA criteria, but the business model is slightly different, which is not you don't want to hold the asset until the maturity, rather you want to optimize your return on the asset. In this case, it will go through the fair value through OCI comprehensive, other comprehensive income. These two accounting classification is basically in scope for impairment as well. So we'll talk about impairment in a bit later. But these are the two primary accounting classification along with the business model. Those, if there are any financial assets you categorize in these two, it will be subject to impairment. Now if we talk about any other kind of cash flows, let's say the return is associated with performance of an equity index. So you have given a loan, all right, a loan at a LIBOR, plus I will give you, let's say, Reliance's shares performance is above 120% of the current level. So if this kind of a linkage is happening, which is slightly linked with the derivative component, then those will not meet the SPPI criteria. So you are, in this case, the instrument will go for fair value through P&L. There could be another example, probably, let's say, the commodity linked performance. It could be like an inverse floater, so, or a constant maturity kind of swap. So probably it's slightly not self-explanatory. So constant maturity, what does happen is basically, the instrument is a floating rate instrument. Let's say you have taken a loan. In our Indian scenario, let's say you've taken a mortgage loan. Right? It's linked with, let's say, in future, if it's linked with the repo rate, what RBI is declaring. Now, or MIBOR rate, for example, that will be even better. So if it's a MIBOR rate, which is the interbank rate, and MIBOR has a various tenor. You have 1 month, 3 months, 6 months, 5 year, 10 years tenor. So when you're saying the constant maturity swap, what is happening is you will exchange the cash flow, let's say monthly or the quarterly, but the reset of the cash flow, reset of that, basically the interest rate which will be getting computed on that loan will be based on, let's say, 1 year, 5 year or 10 year of MIBOR. So what you're doing is every month or every quarter, you're paying the cash flow, but it's not monthly or the quarterly frequency. The underlying index is based on a year or a 5 year or 10 year, which is slightly different. So there's a difference between the tenor in which the cash flow is getting settled versus the reference rate tenor, which is being used to pay the cash flow. So if these kind of mismatches are there, then those will not qualify for amortized cost or FVOCI kind of an asset. There come one another component. Let's say the credit risk related variability in the margin. So when I say credit risk related, let's say the same example, you have given a loan. It's again the floating index reference rate, but the margin on that index is linked with the credit risk of the counterparty. So let's say when you're given a loan, it's a AAA rated counterparty and you have started charging 200 basis points on the base of the on the base rate. In the contract, you specify if the credit rating of the counterparty T2 rates from AAA to, let's say, single A or triple B or even below. So you might define your margin on the asset or margin on the loan is going to get increased. So in these cases, what you are doing is, though there is a variability in the margin, but it's credit risk related variability which is allowed, and this will qualify for amortized cost and FVOCI accounting. Now, apart from that, there are other options which is basically for accounting mismatches. So where you have underlying assets following one kind of an accounting. In this case, you can go through fair value options. Let's say your loan, which is ideally will hold to collect business model when classified for amortized costs, but the hedges doesn't meet hedge criteria and those are fair valued. In this case, you can fair value your underlying loans as well to reduce the accounting mismatch and reduce the volatility in the P&L. There are certain other elements which is like a strategic investment in the equity securities. So in these cases also, it will be, in normal scenario, this will be subject to fair value through P&L. However, when it's a strategic investment, there is an option which allows you to do the fair value through OCI. However, any realized P&L will not be subject to the, will not get recycled to the P&L. So that will stay there. Speed is fine, or I'm a little bit fast or slow? It's all good, right? Okay, so as I mentioned, contractual cash flow, which is the SPPI test. So what we're talking about here is same thing, similarly what I tried to explain. And if you look at the examples, what are the features which will meet the SPPI criteria? It's a fixed rate interest, variable interest rate, if the tenor matches the reset period. So what I tried to mention, explain that constant maturity swap kind of a feature should not be there. Then prepayment features, if the prepayment amounts substantially represent unpaid principal and interest. So if there is a large penalties associated with the prepayment, probably it will not qualify for SPPI as well. The features which does not meet SPPI, so as I mentioned, it's an equity or commodity link. You have leverage interest rate, for example, in the example which I quoted, MIBOR, it's a 3 times or 4 times of a MIBOR you're going to get exchange, then probably this will not qualify. Inverse floater, which is your reference interest rate minus a certain percentage or certain basis points, that will not qualify for this one. Then interest free period in the loan. So there is very interesting fact here. So interest free period, what? So initial few sometimes there is no interest, but if you built in that interest in the future cash flow, then it's fine. There's another thing like interest instead of paying in a cash, if you're paying in a kind, or it's getting added to the principal, that is also allowed. Mostly, I think, other than that, I think I saw to covered. So just one more last item, probably on the interest side. What can be part of the interest component which is being paid on the instrument? So one is the time value of the money, which is definitely. The credit risk component which you are taking on the counterparty, so that's another component. The credit risk can be fixed in basis points, let's say 2% on the base of base rate, or a certain percentage based on the bucket of the credit rating if it changes. Then you have a basic lending risk and cost. So what does it mean, basic lending risk and cost? So if you have entered into, let's say, a fixed rate bond, or if you have done a fixed rate loan something, and if you're trying to hedge, the hedging is also part of that whole package. And if you want to pass on the hedging cost to the client, that is also allowed under this one. And a reasonable profit margin on top of it. Anything over and above this, probably this will dilute the SPPI test. Okay, so now how does the business model assessment works? So business model in this case, it's being assessed on the pool of asset. It's not an asset by asset or instrument by instrument assessment. So what you need to look at is what is your overall pool of asset and what is the behavior of the underlying asset of the business model, rather than going through each of the instrument and trying to specify whether this will meet hold to collect business criteria, whether the SPPI is getting met on the particular instrument or not. Rather, it's a holistic assessment which will happen at the portfolio level. Now, that pool of assets should reflect the characteristic of hold to collect business model. So if there are some deviations, then it's not allowed. Now, what happened when you're saying my business model is hold to collect, but there are certain sales out of that portfolio? Any idea? Anyone? So I'm saying my business model is hold to collect. I want to retain the asset until the maturity, and I want to realize the cash flow associated with the asset. But in between, if you are selling certain asset, what will happen?
Bifurcate the group.
Sorry.
Bifurcate the group, hold those assets into the model where you are into this one. That should be under FOCA and this should be under amortized cost.
Right. So that will happen on the day one when you are primarily entering into the contract. You will understand, you will try to find out whether it's an amortized cost or an FVOCI. And if that point in time you segregate it, the business model can be dual business model. You can have a secondary business model in your business where certain assets you keep for hold to collect and sell model, and certain assets you keep until the maturity. But what happened, let's say initially I classified everything in amortized cost, which is HTC, and subsequently certain sales happens out of the portfolio. So the standard, and again I'm not going to the standard language per se, but what does it says is, in certain scenario, some sales are allowed out of the hold to collect business model as well. Though your business model is not hold to collect and sell, but still you can have certain kind of a sale out of the hold to collect model. What are those conditions? So one of the prime conditions will be if there is a significant deterioration in the credit risk of the underlying asset. So when I say significant deterioration, means let's say when you lended a loan, it was a AAA rated company, and the margin which you charged is, let's say, 50 basis point on the floating rate. And suddenly, because of XYZ incident, the credit rating of the company goes to BBB. So there is a significant change in the risk the day when you have inherited the risk versus subsequently. If those can be evidenced and substantiated, you are allowed to sell those kind of asset out of the portfolio, and still you will qualify for hold to collect business model. There are certain other examples. Let's say you sell closer to the maturity. I have 5-year loans. I'm already in the 4.5 year, and at that point in time, if I'm selling and the sale price is primarily just reflecting the remaining 6 months cash flow, which I'm just present value of the six months cash flow and getting accounted or getting exchanged at that point in time. So that suggests that most of the cash flow associated with the asset is already been realized, and those kind of sales is also allowed out of the portfolio. If there is a change in certain regulations, in those kind of scenario, it allows. So let's say in your certain change in the regulation which drives a change in investment policy. So my investment policy allows me to invest in BBB securities, and suddenly because of the regulatory change, I can no longer invest in BBB securities or BBB assets. So in this scenario, the standard allows you to get rid of those assets, and you can sell out of the hold to collect business model as well. The other item, which is significant but one-off incident, and the last one is insignificant and infrequent asset sale. So if all these 5 or 6 conditions in which you can sell, there is a last one which talks about if you are selling the asset on account of optimizing the return on the pool of the asset, or to reduce your RWA, basically optimizing your balance sheet utilization. In these two conditions, this will not qualify if it is beyond a certain threshold. So you will fail SPPI and the hold to collect business, sorry, not SPPI, hold to collect business model test. So let's say I'm having a frequent sale out of the portfolio, which is not meeting any of the 5-6 criteria we talk about, but still you want to sell the asset, which is to increase the return, or you no longer want to have a relationship with the client and you go and sell in the market. The standard said it should be very minimal. There is no percentage which has been defined that at what percentage will be considered as a minimal, whether it's a 1%, 5%, 10%. So in a consultation with the probably the auditors and what is being practiced in the market, if it is less than equal to 5% of your weighted average life of the over the weighted average life of the portfolio, then it's considered it's an immaterial, insignificant sales, and you can still continue to qualify for hold to collect business model. So how do you find out what is 5%? When I say 5%, it's talking about the weighted average life of the portfolio. So let's say you have a pool of asset, and when you look at the weighted average life, the asset will be ranging from, let's say, less than a year, 2 year, 5 year, 10 year down the line, whatever. So what is the life of the average life of the portfolio? You come across, let's say, my average life of portfolio is 3 years. So over the 3 years, I will be anyways extinguishing entire portfolio. So in this 3-year period, if your total sale is less than equal to 5%, then you can still continue to qualify for hold to collect. Now there's a trick in between. So if you consider, your credit card portfolio, let's say. So in credit card, what happens is, in usual sense, everybody gets a limit, right? So you will get 1 lakh, 2 lakh, 3 lakhs limit on your card. But not on a day when you will utilize 100% of that limit. 1 month you might utilize 10,000, 50,000, 1 lakh, 1,50,000, whatever. So there is 2 components in that product. One is what is on balance sheet, how much you have utilized. The second component is off balance sheet, which is the unutilized portion of that, right? So the on balance sheet is a straightforward that becomes financial instrument, goes into a balance sheet receivable. There is a 5% threshold which is being applied on the on balance sheet side of it. When it comes to off balance sheet side, which is the contingent liability for that matter, right? Because you have committed, you will allow them to utilize that limit. What happens if, let's say, you are selling the pool of the asset, which includes on and off both together? How do you apply that 5% ratio? That's another aspect. So what happened in industry, they said fine. So on a drawn basis, you continue to monitor it again 5%. But when it comes to drawn and undrawn together, probably 10% could be an appropriate level to assess. That's not golden rule yet, and it's not been defined in the standard. It's still debatable, but what is being practiced is the 10% in the overall pool of assets, which includes your on and off both balance sheet together. Anything? Any questions before I move on? Okay, so how does this SPPI work? So what first criteria you will look at the business model, whether it's a hold to collect or hold to collect and sell business model. If it's not on that business model, it straight goes to the fair value through P&L accounting. Now, if it is, the business model is either of one, then what you look at is whether you are financing it to an SPV. So SPV is a special purpose vehicle, which is being designed or created to get funding. So I'm probably I will touch base a little bit more about how does SPV work in the coming slides. So if you are financing to an SPV, then what happens? If it's not a straightforward apply SPPI test, and you will find out whether its underlying assets are meeting SPPI or not, and you will classify accordingly. If it's an SPV, whether there is a tranching which is involved in the SPV. If it's a tranche, then there are two rules under CLI. So if it's a tranche, it goes through a CLI, which is contractually linked instrument. There is another lens we need to look through those assets. If it's not in a tranche form, then there's another rule which is called non-recourse lending. That's where the rules, we need to go through the non-recourse lending in this case. If it's a non-recourse lending, yes, then apply the non-recourse financing test. If it's not, then SPPI. How does it work probably? Before that, I will go through this example. So take an example, let's say Maruti Suzuki. Right? It's an automobile industry. Along with selling the vehicle, what they do? They do provide finance. They give you a loan to buy the car itself. So if they have given you a loan to buy the car, so they haven't sitting on the asset which is a receivable on those. Now their primary business is not to finance the vehicle. The primary business is to sell the vehicle in the market and make revenue out of it. So they want to free up their capital, which is actually the loan which has been given to various customers like us. So what they do is, they pool all these assets and park these assets into a special purpose vehicle. So this special purpose vehicle is, it's in basic sense, it's in a bankruptcy remote kind of a vehicle, wherein it works as an independent. Whatever the pool of assets you have, if you are lending to vehicle, you will have access to the pool of those assets. It doesn't have any linkage with the previous ones, right? So now, once all this asset has been, let's say, transferred from Maruti in this example to an SPV, what does the SPV does is, the pool of assets, they will try to first find out what is my weighted average credit rating of the pool. Let's say they comes up with a single A rating of the entire pool. Some of the credit rating reach out to credit rating agencies. They say, based on the characteristic of the quality of the assets and the characteristics, maturity, blah blah stuff, everything together considered a weighted average rating of a single A. Now they said if you go and sell this in the market as a one single paper, probably you will not realize a good money out of it. So what do they do? They slice the assets into various tranches. So when you slice the assets, what you do is, you will take out certain portion which is the high quality assets in the pool of bucket. It's not a specific identified asset, but a pool of bucket. You will slice into 2 or 3 tranches. So the first tranche will be a high rated tranche, probably let's say AAA rated tranche, wherein it will be very less risky. You will have a good quality assets in there. You can have a mezzanine tranche, which could be, let's say, in this case, assume it's a single A mezzanine tranche. And then the remaining, which called is the third tranche or the junior tranche, it could be the residual piece. So when the cash flow is being generated out of the loan, how the cash flow will get distributed depends upon the seniority of the tranche. So whatever the cash flow you have realized out of the underlying loans, first it will go to the senior tranche, anything residual which go to the mezzanine tranche, if there is anything left over will go to the junior tranche. So it will follow the waterfall structure. The waterfall structure basically you comes from the top, go up to the down. So first the senior one, the mezzanine and the junior one. Now what happens if your funding, if your investment is in senior, mezzanine and the junior tranche? That will impact your SPPI test as well. If you are holding a senior most tranche, right? So remember, right, what we spoke about. What is the SPPI? You can have your principal repayment, you can have your interest and a genuine margin in it, and a small portion of credit risk which you are taking along with. So if you are investing in the senior most tranche, what is happening is there are two more tranches which is providing you a credit protection in this structure. So most of the time you will qualify for the SPPI. Now when it comes to mezzanine tranche, what happens is the mezzanine tranche will get served only when the senior is fully served. In this case, you are providing a protection to the senior tranche, and your return is actually not only your credit risk, basically a credit risk being taken on the senior tranche as well is also associated with that. So in this scenario, you will not qualify for SPPI. You will not meet SPPI condition and it will fail. Now what happens, let's say, you're, sorry.
What are you saying? You are saying that the senior tranche will not qualify for
Mezzanine.
Mezzanine.
So, and similarly for the junior one as well, if you are holding only junior one. Right? So what happens if you are having all three tranches in the same proportion? Will it still qualify?
No, should not.
Why not?
Why not means the risk is being taken the first percentage. So the risk anyway is still percolating down.
Yeah. But are you providing, if you are having in the same ratio, are you providing any credit protection to someone else? So your junior tranche is providing protection to your mezzanine and junior together is providing protection to your holding in the senior tranche. So if you look from a ratio perspective, let's say 20% of each of the tranche is what we are holding, I am holding. So will it qualify, will it pass SPPI test?
No, how then it is not senior, junior, mezzanine, no?
It's one.
It's one, no?
One with all the factors for SPPI honored.
Right. So that's still debatable. There is no consistent approach or the guidance available from all the big four. Some says yes, it is indeed a one slice of the entire three tranches, so you are not providing any credit protection to anyone else and you do qualify for SPPI. Some says no. If the agreement allows you to get rid of any one of these in between, then you will fail immediately. So that is still debatable, not a industry standard yet, but open for debate kind of. Now, okay, probably going back to the previous one. Yeah, we spoke about two conditions here, two tests rather than CLI and non-recourse financing lending test. What are those tests? If now we understood what is the SPV financing, right? So now we can try to go a little deeper into these two tests. So what is contractually linked instrument and what is this non-recourse financing? Does anyone have any small or basic understanding? How does it work? So the CLI is what we currently just spoke about. So when you have a tranche kind of a mechanism where you're investing in the assets, that's where the CLI will apply, CLI rules will apply. Now, as I mentioned, in case of CLI, if your risk is below the weighted average pool of assets, if you remember the example which we started with, the pool of assets is having a rating of A. If you are having an asset investment in any of the tranche which is rated on or above A, which is better than the rating of the weighted average, rating of the underlying pool, then mostly you will classify for SPPI test and you will qualify, you will clear the SPPI test. If your investment in the tranche mechanism is below the weighted average rating of the pool, then it will not. The reason being that you are providing a credit protection to someone else. So if it's going through CLI, which is a tranche mechanism in SPV, then the CLI rules will apply and accordingly it will go. Now in CLI, what happens? The underlying portfolio in case of CLI can have a small portion of a derivative component as well. So remember earlier we spoke the business model and the SPPI. If it doesn't meet, it straight away fail SPPI, it straight away will go to FVTPL. But when it goes to SPV tranche mechanism, the underlying pool of the asset in that SPV can have a small portion of the derivative component, which should be kind of a plain vanilla component providing a risk hedging mechanism to the overall pool. So in this case, let's say you are having an automobile loan given to various customer and you enter into interest rate swap to reduce that interest risk associated with those loans, then the overall pool of those assets will still qualify for SPPI. When it comes to non-recourse financing, the non-recourse financing can be in the form of SPVs as well. Right? That's first thing. And in this case, the pool of asset, and in this case the asset can be basically your non-financial instruments as well. So which is like property, plant and equipment. You can have various rights to receive royalties, etc. Those kind of stuff. So in the non-recourse financing, what happens is you are lending that SPV without having an access to the cash flow of the underlying pools. So in this scenario, just give me 1 second. Yeah, so in this scenario, there are a couple of things which happens. So what happens is you need to look through that what kind of a characteristic of the underlying pool or the SPV structure is having. So let's say the SPV is having an over collateralization. So when I say over collateralization, you pool the assets, let's say 200 crore of asset has been pooled in the SPVs, but the notes which you are issuing in the tranche format is only 100 crores out of it. So in this case, what will happen is you have already over collateralized the SPV to serve the cash flow which is coming out of. So the senior, mezzanine, junior, all the tranches will get served given that it's already 100% over collateralized. So there's a very minimum credit risk which is associated with that. So you will still qualify for SPPI. There can be another mechanism like your parent company has provided a guarantee to that. If the SPV is not able to meet, you provide a guarantee. You can have another instrument called financial guarantee. If it's been issued by SPV, as somebody has already provided a guarantee on those underlying assets, then that will also qualify for that one. Now let's talk about the credit risk should be de minimis. What is de minimis? In this example, we spoke about its over collateralization, guarantee, etc., etc. But what is the level? It should be 10%, 50%, 1%, 100%. What could be? So, yeah.
Where is it referring?
Okay, so that's
Minimal.
that's right side, the bottom box.
Okay.
So it says the likelihood of impacting the cash flow by more than 1% is what the means.
1%.
The likelihood of impacting the cash flow is more than 1%. So let's say it's 100% collateralized and there's a very remote chance that your cash flow will get impacted because of that. Then yes, it still qualifies. Now we spoke about this tranche structure, right? Slightly more into the SPV side. What happens when there is only a single tranche? The notes is issued but there is no multiple tranche like senior, mezzanine, junior. It's only one single tranche is issued out of the SPV. Yeah. So in this case also, it follows the similar approach what is being followed in the multi-tranche structure, and similar conditions will apply. Over-collateralization, financial guarantee, etc. What is the credit risk? If it is a de minimis, etc. You will still qualify for SPPA. There's another form in which you can still finance an SPV. That's called the whole business securitization. So in the whole business securitization, what you do is you still create an SPV and transfer all the cash flow which is being generated out of the operating business to an SPV, and then SPV issues a note and you go and invest in those notes. So in our example we spoke about is there is a specific asset which has been carved out of the operating company, which is loans, and parked into an SPV, and then the notes were issued. In the whole business securitization, what happens is the entire cash flow of the business, in the example Maruti, the cash flow generated out of the loan along with sale and the various other ancillary activities, spare parts, etc., all has been bundled, pooled into one group and has been passed on to SPV, and SPV is issuing the notes out of it. In this case, what will happen? So you will have a multiple assets. Some are qualifying for SPPA financial assets, some are property, plant and equipment, intangible assets, whatever, royalties, etc., other fees, franchisee fees, various other kind of income coming into this. So will it qualify for SPPA? No? Yes? General sense? No? I think yes. Why? It's as good as you are giving a loan to an operating company, it's nothing different. So it will still be qualified, though the underlying pool is having a revenue which is associated with the non-financial instruments, it will still qualify. Okay, I think I touched upon, I taken a lot of time on the business model and SPPI side. How much time actually I have allowed to? 1 hour. Okay, so I'll quickly run through the impairment, probably. So post IFRS 9, the impairment has been categorized into 3 categories specifically. It's called stage 1 impairment, stage 2 impairment, stage 3, unlike IAS 39 where we used to have an identified and unidentified impairment. So one is incurred loss, one is expected credit loss. That's a huge difference. What happens when it's IFRS 9? When the asset, on the day one when you inherited the asset, you will start having an impairment provision on it. Whether it's an, let's say, AAA rated investment in a US government securities itself, still it will have some impairment on that. Theoretically, 0.00 whatever percentage of probability of default, that will get applied and you will have an impairment. Unlike what IAS 39 don't used to. So it's a huge increase, material increase in the impairment numbers post IFRS 9. Now there's another thing is, you don't recognize the entire impairment on the day one. When I say that the entire impairment, it's basically how much is the expected credit loss you are expecting to have over the life of the asset. When it's stage 1, you just estimate how much loss you will have in the next 12 months period, rather than an entire life of the asset. So in this scenario, it will be slightly lower, or not significantly lower than the entire expected life. Now, when does the asset move from stage 1 to stage 2? Yep, I think it's not very clearly visible, looks like, but so when this credit rating of the underlying asset is significantly deteriorates. So when you say significantly deteriorates, what does it mean? How much change is significant? So let's say 2-3 notches. That's very significant, definitely. So let's say AAA, 2-3 notches down is to BBB. That's definitely significant. Let's say 1 notch down. AAA to AA, will it be significant? Or one further notch down, from AAA to single A, will it be significant? How do you ascertain what is significant? And when do you need to move from stage 1 to stage 2? There's a large implications when you move from 1 to 2, given that the stage 1 is just 12 months horizon and stage 2 becomes the entire life of the trade. How much loss you're going to incur. So what we look at it is, if there's a change in the risk, how do you ascertain the risk? How do you measure the risk in terms of a margin or the basis point of the credit spread? Let's say it's a 100 basis point credit spread you're going to charge on the counterparty. So that's what your credit risk is. If the credit risk is changing by more than 20 basis point, irrespective of the notch, whether it's still in the same AAA, AA or whatever rating, if it's changing more than 20 basis point, or the change is greater than 10% of your original credit risk. So your original credit risk you charge 200 basis point or 300 basis point. If it's changed by 30 basis point, or in absolute term is changed by 20 basis point, then you will consider that there's a significant change in the risk which has happened. I think it's not defined in the standard, but the general practice is what is being followed. Now what happens in terms of revenue recognition when you're moving the stages between 1, 2, 3? So when it's the stage 1 asset, it's kind of a performing asset, everything going fine, you continue to recognize all the associated income, revenue in the P&L, which is your interest, in primarily when you talk about financial asset. When it's moved to stage 2, you still continue to recognize the income on the entire gross carrying value. There is no change in the income recognition. When the assets move to stage 3 from a stage 2. So in stage 2 we talk about significant increase. Now the significant increase is so much that it has reached to a stage which is called credit impaired asset. So the credit quality is significantly deteriorated, that you are having a large expected loss has gone beyond a certain point. So in this case, these assets will move to stage 3. And when the asset moves to stage 3, your revenue recognition changes. Instead of a gross interest on the gross carrying value, you now start recognizing on the net carrying value, which is your gross assets adjusted with the impairment number. So you have 10 million assets, 5 million you already provided for the impairment in stage 3, you will recognize revenue only to the extent of 5 million remaining. So that's one significant change. Now, when the asset will move to stage 3, one is significant credit deterioration. There are a couple of other factors also, like days past due. So days past due is the concept where the cash flow is due on the assets. Let's say interest is due, but is not being paid on the due date. So when the receivable, the aging of the days past due is increased beyond a certain point, let's say it's 30 days past, still the cash flow has not been realized, the asset will move from a stage 1 to stage 2, though the credit rating remains same, there is no change in the credit rating, still it will move. If it is more than 90 days something, it's a 30 to 90, it will move to stage 2, and it's more than 90 days, it will move to stage 3. So there is also one of the criteria to move, will impact the staging of the asset. Now how the expected credit loss was measured. So it's a very simple formula. You look at what is your probability of default, what is the exposure you are expecting at the time of default, and what will be your loss at that point in time, loss given default. The function of these three will give you what is your exposure at default. Sorry, ECR to be charged. Now, when you come up with this, the standard said I think probably minimum 5 economic scenarios is what you need to consider when you are doing a computation of ECL.
But this is all is put on Basel itself. Basel 3 talks about all this what you said.
So that's more of a capital rule, right? This is more in terms of accounting, how you are recognizing. So, sorry.
Okay, see,
Yeah.
capital rule, for the capital rule, I have to ascertain the risk weighted assets. And how do I ascertain the
case, which will go into your P&L.
That is in capital. What?
It will
How much you
impact
need to
your-
keep?
Yeah.
It will have probably a double impact because it goes to your P&L. Your capital already is eroded. On top of that, your base has eroded now. In the previous one, you didn't have this in your P&L. You had a risk-weighted asset you actually calculated. In this case, you'll have to calculate the risk-weighted assets. Plus, this is one and eroded your capital as well.
So your capital is already going down here. So it's a double sword kind of. Thanks, Cappy. Okay, so there are certain disclosure, probably in the interest of time I will not be going through those ones. Just one small topic on the modification I would like to touch upon before I hand it over to Raja. What is modification? There is one special topic which is in IFRS 9, talk about modification, right? If you are modifying the characteristic of the underlying.
Before we go to new topic, so the last stage when we are calculating that expected credit loss rate.
Yeah.
So when we talk about full life of asset, something like credit card portfolio, how do we assess the life of the asset?
So then you move into the behavioralized life of the asset. So what you do is you look at the entire pool of the cards and you try to find out based on the history and the simulation that what is your expected behavioral life of the underlying pool of the assets, rather than, because as you rightly mentioned, it doesn't have an expiry. Though the card has an expiry, you don't go by the expiry date. What you look at the behavioral characteristic of the entire portfolio, what you're expecting this to last for.
It's completely on the history.
History you can have in future forecasted simulations based on the economic scenarios. So how much is, let's say, if you talk about scenarios, there are 4 or 5 scenarios we use, basically UK and US employment data, GDP, real estate index, etc. to come up with how much I am expecting. It's a good question. Thank you. Okay, so modification, just a small topic, bigger topic, sorry, but I will just briefly touch upon it. So when you are changing the characteristic of an underlying asset, it qualifies for a modification. But if there is anything which the existing contract allows you to change, that's definitely not a modification. If you're changing the interest rate, you're changing the period, if you're changing the currency, if the existing contract allows all those kind of amendments, those are definitely not a modification. Anything which current agreement doesn't allow you and where you need to renegotiate and change, that will qualify for modification. So what happens when the underlying financial asset is getting modified? Will there be any change in the terms of revenue recognition out of the asset? This is what the IFRS 9 briefly, or not briefly, detailed, he talks about. So when there is a change in the underlying characteristic of the asset, you need to go through and assess whether the characteristic change is a significant in nature, which is substantial modification it's called, or a non-substantial modification. So how do you define substantial modification and a non-substantial modification? There's a simple flowchart actually, probably rather than going to text, I will go through this one. So as I mentioned, whether the change is permissible in the terms of the contract, if yes, it's not a modification, just stop there. If it is not permissible and still the change has happened because of the renegotiation or bilateral discussion, then there are 2 tests which you need to apply for. One called qualitative test and the second one is quantitative test. The qualitative test, you see whether there is a significant change which has happened in the characteristic of underlying asset. If yes, then this will be considered as a substantial modification. At the same time, the quantitative test tells if the change in the cash flow of underlying asset is more than equal to 10%, it will be considered as a substantial modification. If anything is happening qualitatively or quantitatively, qualifying for a substantial modification, in this case, the existing assets get de-recognized. When I say de-recognized, you will recognize all the, let's say, revenue associated with that. You will get rid of the asset from the balance sheet. Revenue will get recognized to the P&L on the existing assets, and the new asset will start. There is one significant change when this happens in terms of impairment. What happens is, if it's a significant, substantial modification, your probability of default, which is being used for impairment calculation, gets reset. So what does reset means? Let's say I've taken a financial assets 3 years back and now I'm doing a modification. So when the impairments get calculated, it's calculated based on the origination date, which is 3 years back, still if it's the same asset. When the substantial modification happens, the PD of that asset will reset to today if the modification is happening today. That will have a significant impact. Your impairment will subsequently significantly reduce the moment you will have a modification, substantial modification. At the same time, you will release all the revenue associated with the old asset. If there is any new revenues or new upfront fee, etc., you are getting on the new asset, you will start amortizing from today on until the new maturity, if there is anything. If it's a non-substantial modification, that is even more complicated. Why I say is, you continue to recognize the revenue of the existing asset, but because of the change in the characteristic of the assets, the cash flow of the assets, you recompute what should be your value of the new asset. So the new cash flow, you discount it using the old EIR and then compare what was my cash flow at the old asset versus the new assets, and any difference you have to immediately recognize in the P&L. So that's even become more complicated in terms of when it comes to practical applicability. So to do away with these calculations, industry has come up with a materiality threshold and other stuff, like if it's beyond a certain threshold, 1 million, 2 million, 5 million, etc., then only we'll do this calculation, recognize. Otherwise, given that insignificant, will not go through this process. That's pretty much actually. A couple of other stuff, but I think in the interest of time, probably I will just wrap up here. Any questions before I hand it over to Raja for big data? Right, thank you very much.
I had a general question. So normally these are European standards. So what is Indian standard equivalent of that?
I think these are more qualified people probably.
I just want to understand. Do we normally follow what is European or American? Then question for my question. Reading IFRS 9 for this.
See, India has converged with IFRS. All the new standards, be 15, 16, are almost in line. Only the number changes. It's no longer called IFRS 15 or 16. It's called, I think, Ind AS. But the name changes, but almost the content is same because we have converged, not fully adopted. Like you say, Pakistan is adopted. So whatever standard comes, they copy paste. India will do the same, but will go through the filtration. Like Dilip said, some of them I may remove. Like I may not apply 10% threshold. I may put 8% or 12% suiting Indian context. But more or less whatever you cover will be applicable for Indian clients.
There will be some carve-in and carve-outs applicable to India.
So we do some.
We are allowed, as because you have converged, we are allowed to make slight changes to the international standard, but we have to keep the principle or the content almost similar. Else we lose that IASB's blessing that we are fully converged, or that kind of a thing. Like US GAAP, if you see, is not converged. They have their own standards.
Yeah, that's right.
They don't even have, like Dilip mentioned, expected loss model. They still are going with incurred loss model. And this IFRS 9 is one of the major reasons why US is not converging with IFRS. Because they don't want to take this expected loss, which will increase a huge P&L for them. Because they're telling if the customer is paying, why is the question of me taking impairment? Like you've taken a personal loan, you're paying 3 EMIs. Why are you charging me impairment? Though he could be whatever, like he said, credit spread increase, rating went down. US GAAP says I don't care. As long as he's paying from AAA, if it becomes CCC, I will still not take any provision on that. But IFRS wants to take.
Very, very interesting and very relevant question. So in that same question, it's a follow-up question. So in their balance sheet, won't they have impairments?
US GAAP.
US.
US will have only when you default. When I don't pay 90 days, 3 EMIs, rule based, then only I have impairment.
It was a case before IFRS.
IFRS.
also had the same problem.
Okay.
In 2008 crisis, we realized that, like Dilip said in the beginning of the session, that we had to revisit that why we didn't create provisions. After the crisis, we realized we don't have enough provisions, and we took a huge loss. Citibank was almost about to close.
True.
And this is why IFRS 9 has
So not only capital, so the expected loss also.
Yes.
So very interesting, and thanks.
Thanks, Uday, for asking that, and thanks for clarifying.
That is has relation with the Basel fee, but we keep reading on newspapers, we don't understand.
We'll do the next breakfast meeting on Basel then. That is a good point. We'll tell DG sir to bring in that context and give more back-to-back explain.
Okay, hi, my name is Raja. So I'm not a finance person or a CA. I'm here because my friend Pasu said, can you come and meet a bunch of interesting folks in the ICAI, and I thought I'll get some of my colleagues. We prepared something very fast and we just wanted to go through this. So this is not in any way a technological presentation. So this is just to give a view of what big data is and how it's used. Right? It's a presentation made by my team, but I just thought I'll just go through it, and I'd like to keep it as interactive as possible. So it's not going to be a one-way street. You can interrupt me wherever it goes, and we'll just have it. And you should also know, don't ask financial questions. So I'm quite far away, and so are my team. So in fact, when
What you think?
yeah, so whenever he was telling special purpose vehicle, I was thinking of share auto. Okay, so that's the limit of. Oh my God! It's not an auto, it's not a bus, it's not a car. What is this? Right. So coming to big data, right? So I'll just take a sense check of where we are. So how many people here know what big data is? Good.
Very elementary understanding.
Right. So no, I understand now. So, and how many people here know Tamil or don't know Tamil? Okay, a couple of guys. Right. I'll try because in the flow sometimes something, beach mein aa jata hai. That I am telling in Hindi as if it makes a lot of difference to Tamil folks. Okay, so this is what I'm planning to cover, right? The evolution of what big data is and everything. So this slide you would have seen in so many places, right? So the reason why I'm bringing this up is not to take you through a history of how data evolved, but to give you a context. What is this? So if you look at 1890, the punch cards were 0.08 KB. In reality, today, even if you try, you can't create a file that small. Okay, you just open Notepad, put hi, close it, it's more than 1 KB. Right? Just imagine the context from where we are now. Right? And the second row, second column, you have this floppy disks, and I'm sure in your lifetime everybody would have seen it, and I've seen it when I was growing up, right? So the big size floppy disk is 1.35 MB. Now in context, your latest Apple iPhone or Samsung photo is 4 MB. So just imagine you need 4 floppy disks to store one photo which you can take today. So something has happened from that time to this time, right? So what's happened is data has exploded. Right? And then you see here we've got USB flash drive, and there's a conscious reason why we kept the hard disk combined with the network storage devices and the cloud. The context here is the hard disk in you all have laptops or hard disk. It's what, 500 GB, 1 TB, right? So in your office, in our lifetime, you would have seen an EDP department, correct? It is as small as large as your companies and your affordabilities and your business. So I've seen companies where 1/6 of this room had AC and servers. Your mail server was there, your file server was there, your data server was there, database server was there. We used to have IT department which used to go in and out. At least we'll all think they have better ACs than us, right? Now what happened, right? Do you have that in your office now? So something happened, right? So what happened is, as the business grew, the data size became increasing, and that small sized EDP room just became larger and larger and larger, and there's a limit to what you can do, right? And just when this was happening, there was this other highway getting built. The highway is the internet. So what I'm saying is your Wi-Fi, your 3Gs and the 4Gs and the 5Gs, right? So highways are getting built, you are running out of space, right, and infrastructure costs, and somebody else is building the same infrastructure and saying, if you want, use it, right? And they've got businesses, Amazon, Microsoft, Google, right? Amazon has 10,000 data centers. Now, and you will never know, if you are a business, you are taking Amazon services, you will never even visit your data center for a site visit. Okay, I want to go, it's in Lithuania, okay, I'll take a flight. You don't care because data is replicated. Some is in China, some is in America, some is in India. So the concept of network storage, NAS, SAN, and then cloud it is exactly the same. Cloud doesn't mean it's an actual cloud. Somebody was saying, we put so much data in cloud, it stopped raining nowadays, right? So cloud is actually an exactly same physical space. So they've got the same old EDP section. It's just the business moved. They've, like, Ola came and Uber came, somebody moved the data center outside, right? So why is this name cloud coming is because you don't see the data traveling from in your network cable from your desktop or laptop or mobile phone into this place which is in somewhere else, God knows, right? We don't even know, honestly. It's not even disclosed. Even if you ask, they're saying, why do you want to ask? It's all proprietary information. So that is why it's called cloud, right? So I just wanted to show the difference. And why is that cloud relevant for us in the big data that we are talking about is, you've seen the evolution of data, right? We started off, I'm sure, looking at the seniority of the people here, you would have seen DBase, Fox Pro, I think, somewhere at least heard of it, right? In your starting or beginning of the career, your database was held in some, DBase database, and flat files and Excels and MDBs used to run your entire organization. Then came your DBMS, which is more like, your Fox base, DBase and things. And then came RDBMS, relational database, Oracle and SQL. That's when it all exploded, right? And now we are talking about big data. So what is big data fundamentally different from your relational database? It is more flat, unstructured, it can take more, right? So these Oracles and SQL started charging millions of dollars for every year usage. Now suddenly, and just when Oracle and all these big players were charging more, there was a new breed of companies that was coming called Facebook and Google and all these social media companies. And what they were thinking is, if I am to take all this data that I am collecting and putting it in Oracle, I am only going to make Oracle rich, right? So they started putting their technical brains and started using a flat file to store data and retrieve data. That is Hadoop in a very layman's term, right? So the data is all stored in flat file, but it's not as easy as, okay, take your notepad, put your data and then extract it. It's not that easy. So that's where technical brilliance comes in how to store it, how to extract it, and that's where the concept of big data even comes. And you would have heard this terminology called Hadoop, right? Ellathayum Hadoop lo no. So Hadoop. So these two people need translation. So somebody. Thank you. You get it. So Hadoop is so popular. I'm very impressed. So what is big data? There's a technical explanation for what big data is, right? So anything that goes beyond a certain size is called big data. So you can't actually say, okay, that is not big data, this is big data. You can have even small, and you're using it in the context of it's Hadoop, it's Spark Scala, then you're in the area of big data. So let's say you're using only Oracle, but your data size is very much, that also qualifies as big data. So we should not get hung up on, okay, is that technically big data or not? So leave it. It's what you need to know is, there was a time when things were structured. What I mean structure means, you have master data, you have transaction data. You have salesperson data, product data, and then you have transaction sales data saying this person sold this product for this many in this date. And then you kept on going. Now there is no concept like this. People are saying everything is put on just one file. This person logged in at this time, this person saw this product at this time, then this person bought it also. And then this person exited, and this person logged in again. So every bit of data is being used. Those days only sales is there or not. Tell me. If it's not there, please contact later, right? So now they're saying, okay, we can see you logged in at 10 a.m. Then you were playing around in these products. Then you logged off in 12 a.m. Everything is important now, because they are looking at customer experience, right? Because you're not facing face to face, you're only shopping in Amazon and Flipkart. The experience is only what is given in the internet, right? So all data becomes important, and that's where unstructured data becomes all the more relevant. Now this is, I think, my team's attempt at being T. Rajendra. They use some all V's to explain what big data fundamentals is. So only victory is missing, I think. But I'm not going to bore you with everything like, so volume, velocity. So I'll tell you, there are 3 or 4 things I think you'll need to take away from this. Is the volume just got really big. In our age, we would have heard gigabytes, right? GB is big. Terabyte, 1 TB hard disk, that's big enough, right? So with big data, what happened is the volume just became bigger than gigabit. No longer we are talking in gigabit. We are telling terabytes, petabytes, hexabytes, and now zettabytes. Now the standard is zettabytes. Now you can imagine, right? And every time you go a petabyte or terabyte more, it's 1,000 times. 1,000 MB makes 1 GB. 1,000 GB makes 1 TB. 1,000 TB makes 1 petabyte. So it's like nowadays it's common. I need 4.5 petabytes of data. You know, every time I hear this, I get a heart attack. Only. What are you doing? Right? Where is all this data coming from? But it's there. It's relevant. It's needed. Because of that customer experience I'm talking about, everybody wants to store everything. Right? It's no longer just transaction. It's about everything. I think the only thing that's not logged is whether you want to log into Amazon or not, which you're thinking is not logged. Other than that, you open, click Amazon, finish, data starts entering. Right? So that's how, so the volume becomes very relevant. Now everything is in zettabytes, and I think they're telling some 44 zettabytes, and I don't even know how many zeros are there, honestly. Okay, is what is predicted for 2020. And there are servers across the globe which are actually absorbing that data. Then the other important thing you need to know is variety. What is variety? So if you might know, even in Excel there is a data type. Date data type can only have date data type. A varchar or a text data type can only have text. And the numeric should have only numeric. If you put something else, it will say wrong data type. Now, with big data, I think that has also gotten, so you can store anything and everything. So the secret is not in storing, the secret is in retrieving. So they've changed the game from having a very structured database and a structured master data and transaction data. They say dump everything in. And then use, coding like Hadoop, Java, MapReduce and all this to figure out what do you want to extract from this. Make your extraction as relevant as what you want to use it for. So the game changed, right? So that's another context you need to know of big data. The other is I would go with venue, right? So it's completely distributed. Databases, so somebody had a question?
Still it will be in structured format or unstructured?
It's unstructured. So you can choose to have it structured, but there is a...
Occupy more space.
Yeah. No, it doesn't matter. Whether it's structured or not, everything is occupying space nowadays. But because it's unstructured, you get that much flexibility. So if it's structured, then flexibility is lost, right? So you're only going to say column 1 is this, column 2 is this. Now here it's flexible and you have certain ways to extract it. And it's not as simple as I'm making it out to be. You'll need to know that Java code which uses it. And there are now companies that have actually built different products to use Hadoop data. So that old school people like me and all can still write query and get out of Hadoop, right? It's called Hive. I think Facebook created Hive. And now Hive is a separate company. They've rolled it off as a separate company and they're also making money, right? So I don't know how many people here know. FlexCubes is a Citibank product, right? So they first originally started it in their company as an ingrown, in-house.
It became a market product.
Then it became a market product, and every product nowadays is taking that shape. They first do it. If it's very successful, then they roll it off. So that's then the venue, right? So this is the other thing which I was telling. Big data doesn't have to be in a venue. Even companies like Barclays and other big banks have now started moving to the cloud. We used to have private cloud. You know of all people, banks are the most vulnerable is one thing, and the other thing is they are very paranoid. Right? They are super paranoid. Everything has to be in structure. So they are the last to experiment. The technology companies are first to experiment. They'll say, okay, let's go with new technology, freeware, let's do something new. Banks are not like that. They want structure, they want support, they want security and everything. Now banks have started moving. So what does it mean? Now security and everything that is expected has now come to the cloud also. The contracts are stronger, the what I'll call as the disaster recovery and the resilience has become much better. So people have started moving to the cloud. So the venue no longer becomes a case. So I'd like to move on from this unless you have any other Rajendra quotes you want to talk about. Okay, so this is an important slide. It shows, it may not be completely, you may not have direct exposure, but it will help for you to know what is, when people are saying Hadoop, what does it mean? So pig, hive, I don't know how many. So in the underlying, you need some database, which is still the big companies, which are like IBMs and the Oracles of the world, where they produce the underlying data warehouse infrastructure. You still have to use some of their capabilities. The second is actual storage. What used to happen in your Oracle or SQL is now being stored in this thing called Hadoop, right? Kudu. There is another one called Kudu there, and these are very popular. IBM HDFS is there. Then there is this compute layer. On top of the data, what do you use the data for? You have to compute something, right? So the computation layer, you have Hadoop's MapReduce, and this is the third one in the line is where I talked about Hive, and there's something called Pig, right? All these new names, Scala, Spark. So all of this is now being used in banks also. And when I say Barclays, we are also a large bank, so we have not adopted everything on day one. So every bank has it. You name a bank, Citibank, HSBC, Standard Chartered, everybody, including State Bank of India, right? Indian Bank, everybody started adopting this. And the last layer is the visualization. So once you've computed, do you want to see it as a report? Do you want to see it in an interactive report? Do you want to see it in a, so that also is. So these are the high level technologies which are used for various layers of where you use.
What's the difference between fourth and the third? Sorry,
Which one is fourth and where are you counting from?
the distribution of data warehouse versus storage.
Okay, so you need that file under some place, right? So you can't place the file. You'll need the file in an OS or a distributed data warehouse. So that's where it comes. So you start off with the basement, and then you put cement and other things, and then so the foundation layer. You can use HDFS directly on an OS, but sometimes it helps to have these tools like Cloudera. Or
see what happens since you have say thousands of instances of say Hadoop database. So this 1,000 who will do orchestration? So you need someone to follow.
Q and R is very significant in terms of visualization.
Yeah. So R has more capabilities also, right? In terms of, they are even saying if you use R correctly, it can replace SAS. So Tableau and R maybe not in the same sense, but Tableau is now.
PPT we are comparing to Tableau is just a PPT, Tableau or ClickUp.
So it's not just a PPT. You can use advanced analytics on Tableau. It's not like R or SAS. So it is just one of the areas, right? So it is to say after you compute, how do you use it? You can use it here. You can use it. It's not correct to say just R is an analytics tool. It is R, you can use it for something else. And then nowadays Python has come. So after you compute, what do you do with the data? So
all
that's,
the graphics, the visual part.
it's only on the visual side.
So this visualization, we like even in Barclays we use Tableau and Click.
We also use Tableau.
Yeah, so both is equally used.
But she's right, R is more.
All the presentation, yeah. Let's say you will see, like say you as a chartered accountant, you will want to see something, right?
Something as presented.
Yeah, right. So you want to see your graph,
to
chart,
analyze.
Excel is still the most. Excel is still the most
how
used.
this will look like. Right?
Whatever comes here, I have a theory. So when I started as a software development person, they said the big IBM mainframes will go. We'll all move towards RDMS, right? Everybody start learning Java and .NET. This IBM mainframe will go. It's been more than 20 years. I'm still seeing IBM mainframes there. I always used to think if I close my eyes, IBM is sitting somewhere and smoking. You can't kill me, right? So I have a theory about Excel. Whatever visualization you bring, ultimately people need report in Excel. So we are actually using all these grand reporting tools to generate Excel reports and send it. Okay, so somebody in Excel is also probably doing the same.
Power BI is that only.
Get replaced with Power BI.
Power BI is that Excel only.
It is, you still will have Excel. I'm telling you, 10 years down the line, people will still want Excel in mail. I've tried my best, nothing changes. Okay, maybe how to get to the Excel in the mail is what people will. Let's automate this, let's put everything, put the Excel, then send the mail. Okay, so I'm now moving to more how it's used in a bank nowadays, right? So these are areas where it's used in the bank, these are areas where we are also using it. So the first one we are using in calculation of risk capital, and that's a case study, and it's very coincidental, and you won't even believe. Dilip and I work in the same organization. We have not met, and I had no clue his presentation is going to be on IFRS. So it's very hard for you to believe because Barclays is a large organization. Okay, it's like 4,000 in Chennai alone. So across India it's 20,000. So we actually got introduced here, but it was not a planned presentation. So I just want to say we didn't plan for having an IFRS presentation and then
Believe that.
yeah. So I'm not, and I'm not going to pretend that I understand IFRS. Okay, but what we are doing is something which I think you can relate easily. We are doing the back-end engine to calculate the impairments. Okay, and this has been a 1.5 year project, and these two people sitting in your midst were a part of the project, Vijay and Muthu. So what we do is, this is a very good big data example. So why did we do this, and what was the rationale? I'll tell you is, we needed huge computing power because the transactions are in billions. And I was just hearing him speak, so I didn't know the relevance, but for us it's a calculation. Ultimately it's a formula, right? So take all the data for all the customers, go line by line, find PD, AD, LGD, and then do a product of all this. But it's not as easy, and then you have to store the data. And then this is month minus 1. Then every month you just do this month minus this month, right? And every month you'll have to give it to the balance sheet. So I know because I met the head of impairments when I was in UK. So we are giving that data, and ultimately it's landing in the balance sheet, and you are making provisions for this, right? So this is a serious project. If we had used traditional RDBMS like Oracle or SQL Server, we couldn't have had this processing speed. I'll just jump right here, which is, we've got 10 to 12 billion rows. We are processing everything in 8 hours, which is workday 1 we are able to give back to the bank at the beginning of every month, the previous month's difference. So which is a success story, right? So that's what we are doing, and this is to just say what we are doing, right? I think he has already covered all losses minus, I think there are only 2 things which we are reducing: post write-off recoveries and debt sales process. Other than that, we are calculating everything, and this is our calculation engine, which is proprietary to Barclays, but it's just a high-level flow of what we are doing. So we're taking all the data, crunching it in inside the Hadoop layer with Spark and Scala, and then producing the final result.
You're so humble saying not knowing IFRS. How could you do this?
No. It's a very high level, madam, high level. Like special purpose vehicles.
That's the English. IFRS is English. So what we are bothered over the formula.
The formula is tougher.
No, but we know the formula, and we just calculate, give you the number. You do whatever you want to do it.
Correct. So we are dependent on business to give us the formula. So we are not having any delusions of understanding that. Right. So this is the click view. Somebody was asking, how do you finally end up reporting? So click view is what we are using for reporting, and for various SOX complaints and finance report. So ultimately data goes into SAP and some reports which the senior management needs. So with that, some more, I think these are very high level views on where it's being used, right? Amazon lives on this, Facebook is made up on big data, right? And there's another reason why, this is a matter of concern and a matter to be very celebrated also, is your every experience is being stored in that relevant companies, right? So that is to be celebrated, because you don't need to actually call up a company and say, I tried to do this, I tried to buy this product, I faced an error, and then when you're calling, they already know, because all your logs, we are actually doing some of it very similar for various companies in my past. We know exactly what you did. We know exactly whether you used your mobile to try to connect to IRTCC, and then you went to this thing, and then again you came here, you faced this error, you went there, then you called. Okay, so that's what we call customer experience, and that's clearly now every company has it. Whether they will tell it outside or not is different, but everybody has it, and we call it the customer experience dashboard, right? And we also try and bucket how many people while doing this face this. In fact, everybody who has the knowledge of, you at the time of 12 o'clock in the night are playing around finding how much loan you can take, and you are doing a monthly payment of this much. So Google already knows you are trying to play around with this data, and all of a sudden you will get ads which are very relevant to you. Correct? And I was actually trying to buy a stand for a fridge, my own experience. It was around 300 rupees, and I was thinking maybe lesser we should aim for. And I was constantly keeping for less than 300, less than. Suddenly I am getting a mail from Amazon telling the fridge stand you are looking is now available at 225. I called my wife and said there's some CCTV they have in the house. How the hell did they know that I was looking for something cheap? But it's just mathematics. They just went, looked at my search history, And they were figuring out, okay, this fellow wants a fridge stamp lesser than 300 rupees. So let's tell him. So it is to be celebrated in one extent. The other thing is you need to be also scared, because nothing is, private any longer. That famous IRCTC joke I heard, I thought, yeah, you remember somebody was telling, why are you showing this various, ads in the IRCTC site? And then they are telling it is based on your cookie history, sir. We are not doing anything. So they've turned the tables around on you, right? So it's no longer, it's all experience based. So that's what they're doing. But it's what is to be celebrated need not be forgotten, because they already made it easy for the end customer that you don't need to figure out what you want. So when you are browsing in Amazon, only relevant product comes to you. So you can imagine, right? They have 1 lakh products. Even if they sort it, how will they sort it, sir? Which one to show you first? So just imagine, 1 lakh products. You can only see 10 in screen. So how to show you what is relevant to you? So this is where AI and MI, machine learning, artificial intelligence, right? Everything comes. So it's very relevant. This whole big data thing is not an evil thing, but you use it with knowledge and for example, WhatsApp is free. Everybody is sharing information on WhatsApp. Every data is going there in that big data only. Now what will they do with that data? They can do sentiment analysis. They can tell whether Modi is popular in South India or not just by taking the WhatsApp data, right? So they'll know which movie is actually people are talking good about it or bad about it even before the reviews come, right? So they've got so much power in their hands. We only click, say yes, yes, all terms and conditions accepted. They start using the products because they are free. But I'm saying these are real life use cases of big data and how they are using. There's nothing called free lunch, right? So with that, I think my team just put together how big data can be used for an auditor. We don't want to get judgmental. So I know I've given the story, you know where it's useful, right? I think we should, I'll leave it there and open it for questions.
How long does it take for us to read for a chartered accountant to get into this? Because I tried reading after I'm not able to get into it.
We'll try maybe in a structured fashion. Because see, you can't, you should also understand the other way around is very important. I was sitting there half of the time Googling what he was talking about. SPPI, he just assumed that I will know. I don't know, right? So and then half of the time I am Googling, right? What is this? So it's not easy. I think it's different worlds, right? So a developer is nurtured at the age of 20 or 22, right? So his mental mathematics is different. So for him to learn something else, he has to unlearn and then accommodate and everything. Same holds good for you. So it's not surprising, it's not easy, but it's not rocket science also.
No, so my cut on that, you don't need to learn this. What you have to learn, that what you want from your IT department or your IT folks. So you should be able to guide them, say, give me this. Keep constantly questioning them. So you need to learn where this technology can be used.
What to demand out of that?
Correct.
What to demand, until what extent. So now they can calculate, like say,
You can't learn everything and do ours.
Yes.
So you design the models, like say, give me the formula, LG,
Correct.
that I will calculate for you and give it to you.
And the more I think we collaborate, I think the more
We have to collaborate. The time has come for
the bridge between technology and the business slowly comes down. So, but yeah, you really want to use art, then let's start qualifying on why you want to use it. Then probably, there are certain midway points you can meet. Okay, give me
For
this.
the risk management functions, R is essential.
True.
And
So you are
it is
using
not
R for
only
the
for
graphs,
Basel
right?
III reporting. I was working in NBFC, the risk management team for some time. What we do is not only the Basel III compliances and all that stuff. For the normal data analysis, see for example as what we are saying for the loan portfolio, you need to understand there are many value-based reports.
So, I don't know how much, is SAS not there in the organization? Okay, so that's, so normally people with more deep pockets get SAS. And after getting SAS, they'll have a strategy to remove SAS. Okay, so that's what happens. And SAS is another, kind of, they'll also not. But Python is another one that is coming up in the recent past, right? And they are challenger to R also. I'm not going to say Python is easier than R, okay? But I'm saying, over a period of time, something or the other will come and take over the
So
other.
there were discussions between R and Python actually, where R seems to be much more value addition than Python is what an understanding.
No, it's
R
actually the other way
R
around.
is for your reporting and that charting graphs. Python is the language you use R. R also uses Python because like
Yeah.
language there. Like this is a programming language. Python is a programming language.
So if I ask you whether Java or C is more better, your answer mostly will be Java because that's what you say. But I'll say C is more powerful because C, Java's compiler is written on C. So likewise, same as Python is more powerful, but then it's more super programming than normal programming. But having said that, I think if you think in your field, R is going to be really used, and I can understand, right? Even for us, all credit scoring and rating and everything is changing from SAS, and it's all SAS for us. It's changing from SAS to Python recently. They originally wanted to go the R route, now they're going the Python route.
So would you be able to tell me some elements, what you need to look in big data while you are drafting some kind of data governance policy?
Okay, so that's a very, very tricky one because like I told you, first of all, big data doesn't have structure, right? But all the banks have started consuming it. So where I think it comes is these two people were involved in a program called BCBS 239. So what it means is you have to have lineage of from your source data, which is your, let's say, branch banking, either from your FlexCube or whatever, FlexRoute. So from there, how is it landing in your, your balance sheet, let's say, right? So how many hoops from there to here it takes? At least 100. Right, because your source data is probably in mainframe, some green terminal, and then it goes in the batch mode to your data warehouse, and then from data warehouse it goes to another place, and then from another place to SAS, from SAS to some sort of model ready environment, from there some calculation, and before it goes here it makes so many hoops, and I think that's where we have used SOX for governance. So we said this is the lineage, so where big data for us comes is somewhere in the middle. Where we say from stage A to stage B, we have now put this layer, and this is the data it has with this many information of attributes, and that's where the governance comes. Now to that level we can put governance. But right now, you would have heard of GDPR and other things, right? So how your own data is protected, Facebook and Google facing this problem, how are they, and all banks have all information. Everybody has an ICICI or a Citibank or even SBI has this YONO, right? So which means as long as you're using a mobile, all your data is being used. So they can figure out if you're walking into this store's Isapahani center on Saturday, and let's say so many SBI customers are there, they can actually devise a marketing plan for you. But you will say it's my data, why did you use it without my permission, correct? So that's where the GDPR comes. So how do they do the data governance in that angle? So it's a very tricky question. There's no one straight answer. So one part is how you store and use the data. Another part is the outside angle, the regulatory GDPR angle. Any other questions? I know I'm standing before you. Not the lunch. It's only 10:45.
And is there anything that you actually is applicable for big data in terms of SOC 2 reporting? SOC 2, that is the Service Organization Controls reporting. It speaks only about the confidentiality, privacy and security of the data.
Okay, so I'm sure it is applicable in the city, but I don't handle the SOC 2. We do SOCs but SOC 2 I don't know, I'll have to check. I don't have a straight answer. But yeah, if there is a regulation, I'm sure there is a way to measure. See, ultimately it's a file. And we've got specs on what you put on the file, we've got specs on what you take from it. So if you are capturing both, then you have lineage, then you can put controls, what you can take, what you can't take, another thing.
Who can take?
Or who can take.
You said about the cookies, right? So if I disable, they cannot store my experience, or I can store.
There are still ways. So there is this whole. How do they get hold of whether it is you? So cookies is one matter. There is another angle to this. They know the IP from where. So if you are hitting a site, if I go back and say, okay, you come to Amazon today 10:30, How did you come? Did you use your mobile data? Did you use your house Wi-Fi? So let's say you use your house Wi-Fi. Then they'll say which Wi-Fi provided it, and they will have so many IPs that are hitting them to come here. So they know that even though you say it is DHCP, they will have a IP. They can trace from which machine this signal actually came. And there is a huge middle layer which is at work here to figure out. They are not personalizing it, but they know how to personalize. But they are trying to put everybody in a bucket. Okay, so this group of people aged between this and this are, so it's called DMP. They're using it for marketing purposes. Google is selling it. That's how they make money. So they won't personally tell Mr. So and so is doing, but they will tell in this area there is a need for this product because there seems to be more searching for this, more keyword searches around this. And then the advertisers use that data to place either hoardings or advertise individually in your wherever you are browsing. It's all money.
What more we can do, if I don't want myself to be public, I want to...
See, their general advice is go incognito, they say, no? Go in...
Is it really
It's not. You can't be...
No, so use Google, don't use Google, use DuckDuckGo or Tor browser. No, if you are techie, then use Tor browser, right? And then you can keep on anonymizing yourself. On that incognito, use VPN, so that someday you are in Lithuania, someday you are in Poland, someday in something. So
see, all this...
log in, it is a different IP address.
I will not advise all this for retail users because first of all, you wouldn't know which is a safe VPN to use. Right? I mean, technical guys are finding it a little difficult and you don't know what vulnerability you are exposing yourself to. What he is telling is you log in from Poland is what it's telling. All that is right. But is that even safe for you? How will you know? Is there a certified body that says this VPN software you're using is actually good for you? That, like I told you, no free lunch. If they are giving something to you, they are going to take something from you.
No, but you pay for it.
Yeah, there are some, yeah, he's right. There are some places where you can pay for it. I would say as much as possible go incognito. That's good enough.
And instead of Google search, you can use DuckDuckGo.
That's another famous search. That's right. So everybody here is smiling. They already know. What? Any other questions?
All this usage have been happening even before big data.
Yes.
Is there an effect of big data on the usage per se?
It's now cheaper, that's all. So the way the whole big data coming in is faster, more space, more computation, all that is there. And experience wise, right? I told you only transactions used to happen, now the experience also. But apart from that, it is cheaper because you are only paying for space. The computation layer has become cheaper because Oracle used to charge, SQL Server used to charge, all these big companies, Netezas used to charge. So all that layer of money has gone from one bucket to another bucket. So now some other person are
smaller buckets.
Smaller buckets. So money is still going to some people.
A smaller bucket of a different person.
Yes.
So the difference is now, see, earlier probably the impairment and all, bank would be computing based on portfolio. Like home loan I have this much, this loan is this maybe. But now you are computing on every loan, correct? So we can go up to that one row, one customer, one transaction. That is the granularity we can go now. It is easier for us. So if now if you think that, like say, Parle is selling biscuits, now how many distributors across the India they have, and at every distributor level data, you as a sitting a chartered accountant, one person can see how it is distributing, which one is making loss, gain, impairment. We can do, only one person can do it. Earlier you have to get the data from region, distribution, right? Distribution, regional level. It will take a week or month.
All of this can and also be done in the previous case, provided the data was stored. Okay, like I told you, if you only store sales data, what else can you get? That is one. Second is, let's say the old technology is there and you have all this data. the computation time is just crazy. It will take, like what I told, in 8 hours, will be 80 hours.
The dependence of the data validity itself is a question mark those days.
That is also there.
Someone is fudging in between.
Easily they can do. Now you have an end-to-end.
That is true, that is true. I still remember when I was in my first or second job, I was doing a project for EAD Parry. And then we used to do some analysis based on the complaints database. And then we used to give some major graphs. Then they'll say, half the complaints don't get logged. Nah, what you're doing some analysis paralysis. We know, we are in the branch, we know what complaints. So, it is true probably. Half the complaints weren't logged. And it was probably getting resolved. So, your analysis on some data which is not even correct, you're right. But that's now largely, I think, automated.
So with so much big data available with you, example, let's take the case of Barclays itself. Are you able to predict what will be the NPAs instead of after getting the data around 2 years, 3 years down the line saying this is an NPA or something has happened, is colluded, auditors, etc., etc. Is the big data what you have with the AI, machine learning, whatever you are saying terminologies, able to predict, yes, this asset, this row item, this client is going to become an NPA?
Ultimately, NPA calculation is a logic, right?
Correct.
So, we are only going to be dependent on the formulas that you guys give. Correct. So, now there was a Gen 4, now it's a Gen 5 for home finance.
See, IFRS 9 itself, what is that saying?
What is
expected loss.
Predictability pattern.
True, but I'm saying predictability, you will have a certain number of attributes for your model, correct?
Correct.
So, if it is 60 and you suddenly think, if I have 66, I'll probably be able to predict more. Now, as technology, we can say we'll bring the 66 more, 600 more. And from a model preparation point of view, you guys have to tell what is the model to predict. So, I'm saying it's still possible.
For example,
but
sir, like I am now a average guy who has X percentage of my income towards repayments. Suddenly, I have become a spendthrift. Can this be predicted over time? Big data analyze, no, this guy is overspending. So
I would like to answer that question by saying broadly yes, but how big data will also predict? How will artificial intelligence predict? Everything is based on a linear behavior, on a segmentation, correct? So if in that sample size, if so many people do that, they can also predict.
Just to give you an insight, generally what happens is, suppose if it's a client, say beyond 90 days it's going to become a first NPA. So exactly on the 80th day, the manager will call and say, please deposit or transfer the money, X amount, so that this does not fall under NPA. Can this row item predict that this case has happened like this? Why? Because when we go at the year end to do the audit, all this is all we can understand when we see, maybe a small branch it is possible, every row item to check. If it is going to be something like Guindy branch, any X bank or SBA, absolutely not possible for us in a span of 10 days to analyze all these things. So
we can analyze it for you. Now you know what you want.
No, even if you analyze and give, there is no snapshot report saying that these are all the key row items which you need to identify.
So now let's say, now you say that, let's say, can you tell me on 88th day how many customers did the payment?
Correct.
I can tell you that. If you tell me that 88th day, 90th day, 88th day, and which are the customer profile normally does this, that I can tell you.
Okay. Now, is there, okay, so if, suppose they are not providing, can we learn how to extract that?
Yeah, that's what she was also going to know. So the more you understand what is the fields the technology has, the more you can actually ask what you want. I'll tell you a story. I used to work in a credit bureau before. We were managing about 10 credit bureaus, including civil. Okay, I used to work in TNB TransUnion. So we were able to understand that you become 30 day, 60 day, 90 day bucket. So like you said, 30 days you become 31st day you go to the second bucket, right? And just before 30 days also there is we want to know when to call. Now we realize that some people are either habitual late payers or some people genuinely forget. Okay, they don't have this auto pay. And we have realized these people almost definitely pay, but 1 day, 2 days late. Right? So there was a need for a collection score, which we did. You know how it helped? They said at least the calling cost I will reduce. I don't want to call a guy whom I think will pay. Because right now your data will only say, like you said, 80th day, I'll tell you, okay, 31st, give all the I don't want to call all the people because I know 20% of these people or 15% of these people are good guys but who are habitually late. But how do I figure it out? Now that's where it can be used, right? And like that, the same logic can be applied for NPA also. Everything depends on, have you figured out now to come to a collection score, you need the data, right? And you actually need to figure out whether the call is helping or not. And how do you figure out whether the call is not all helping? He is anyway paying in 2 days. And some people pay after the call. So your collection score have to also tell you call this person better. It's okay, one rupee call charge, anyway that payment will come. So all these attributes, for that the model attribute will require this data also. Calling, paying, right? So there are so many factors.
Bill scoring is dependent on call a customer and collect also. It will
True.
reduce.
True. And CIBIL is a massive exercise, right? Because in India, there is no one matching parameter for a customer. But they've done an amazingly good job. I am proud to have been associated with that.
Experian itself had 600 million Indians data. Experian had on all the attributes, like say how many credit cards you have, how many loans you have taken in the life. Each loan, whether you have paid on time or not.
Yeah, CIBIL has all of that. Experian is, in the credit bureau circle, Experian is God. The reason why we tell that is, they have more credit data than even CIBIL. For example, in UK they have where and all you are taking credit. Electricity you are using, then only paying. So you are taking credit. Phone, telephone, postpaid, you are taking credit, then only you are paying. So if we have these two data points, and these are two examples, right? We can even predict. So you are probably paying your credit card fast, but you are keeping, you are not paying this, and that reflects on you, right? As a person, your own credit worthiness and your behavior. So in India we don't have CIBIL. When I was in CIBIL, we tried didn't allow it. We said we want all the telephone postpaid data. They are still trying. They are still getting. So I have moved to Barclays. So it's not that easy. But Experian was able to crack it in UK. No, but it should be available.
Not the EB and telephone bills, but because rather than that, any person, whatever the loan he has taken in the history and whatever the disbursement, everything is being captured in PCR. That is,
PCF.
PCR
is from RBI.
PCF. Okay,
RBI
okay.
is coming out with that.
Yeah, but so what I'm saying is we have already lost 10 years. 10 years of data. So, and it will be a nightmare to go back 10 years and get all that. Right? So you can only do this point forward. You've lost the opportunity to rate. Right? That's the point I wanted to say. So that's why Experian is the best. And he's got so many other small information also. Wherever there is an opportunity, there you've taken credit, they want to record it and tell how you behave. And it reflects in your score. Okay? Anything more? Thank you.
May I request Mr. Mahadev to give a memento to Speaker Dilip sir?
First. Center stage.
Excuse me, madam. May I request you to give a memento to Mr. Rajakumar?
Raja Prabhakar. Thank you.